Let me make this easy. A fund family is flashing a 135% yield while investors watch their balances crater, and that tension is why this story matters. This is insane. You won't believe it. Stick around. You're with ChannelVest. This is your analysis. Hi, I am George, and this is ChannelVest. YieldMax is a set of ETF, exchange-traded fund products promising jumbo income, headlined by ULTY, with a 105% annualized distribution rate. That headline sounds like freedom, but the trap is that distributions and true performance are not the same thing, and capital losses can overwhelm the checks hitting your account. We are going to separate signal from sizzle, show where the cash really comes from, and why millions are getting fooled by optics. If this helps already, subscribe and comment to join the crew. That sets us up to explore the fine print and the legal disclaimer so we all start from the same rules. ChannelVest provides research and educational content only. We are not a financial advisor, broker, or fiduciary. This content is for educational purposes only and does not constitute personalized investment advice. We do not receive affiliate income from any products discussed. Full disclosures available in the video description. Always consult qualified financial professionals before making investment decisions. With that on the table, we pivot to the insane numbers that started this investigation and why they set off alarms. I will simplify what matters here. 4 numbers frame the whole case. 135% ULTE yield, 70B total assets, 72% price decline, and 45% market growth in covered call ETFs year over year. This is the clash investors feel income that looks life-changing, alongside a share price collapse that feels gutting. The implication is simple. If your balance is down 72%, giant distributions have to be reinvested perfectly just to claw back ground, and most people do not do that in real time. You won't believe it, but the result is a product that can look like it is paying you while it quietly erodes principal. The takeaway is that headline yield is not total return. Let us see how that plays with what these funds actually are. Here is the core idea. Traditional ETFs buy stocks and collect dividends, while YieldMax uses a synthetic covered call engine. Covered call sell upside rights means you take cash today in exchange for giving away future gains. YieldMax does not own the stocks outright. It buys long-dated calls called LEAP. Options, long-term calls to mimic exposure, then sells weekly calls to collect option premiums as income. That creates fat cash flow but caps your upside at the strike. In plain English, it is like pretending to own a house via a contract, then selling the right to any price jump each week for rent. Pro insight: this design is inherently path-dependent, so fast rallies can punish returns more than slow drifts. That frames the how. Let us dig into what those distributions are actually made of. Let me make this easy. A big chunk of those juicy checks is your own money coming back. Return of capital, your base is back, shows up loudly here, with 40% highlighted in ULTY, up to 90% in some funds, and only 60% is actual income. Think slot machine math, put in 100, get back 40 labeled distribution, feel rich, but the machine is just handing you your billfold. Taxes can feel gentle in the moment because return of capital is not taxed immediately, but your cost basis drops, setting you up for future taxable gains even if your account lost value. Pro insight: this can flatter yield stats while masking economic loss. Keep that in your head. We compare it with real-world performance next. Time to break down performance reality. The SP 500 gained about 25% while ULTY fell 72% over a similar window. That is a brutal gap, and even if you banked every distribution, missing most of the upside during strong markets leaves you far behind. Covered call income shines when prices churn or fall, but when mega caps sprint, the short calls sell away the very fuel that powers compounding. This is where many investors realize the trick: delicious income cannot rescue a steadily shrinking base. You won't believe it, but that steep decay can continue even as monthly cash looks generous. We just nailed what happened. Coming up, how this engine works step by step. Make into the mechanics first. Buy LEAP. Calls to stand in for owning the stock. Second, sell weekly calls against those calls. Third, collect premiums as distributable cash. Fourth, accept that upside is capped, so big rallies escape you entirely. Each step adds friction costs and path risk. Weekly call selling means constant exposure to gap risk and assignment dynamics, while the LEAP Position can decay as time passes. Pro insight: this structure can resemble selling insurance on a fast car you do not own. The premiums are sweet, but the claim wipes your upside. With the engine clear, we open the hood on how competing income funds compare. Here is the core comparison. JEPI posts 8.4% yield with a 0.35% expense ratio and positive 5-year performance at moderate risk. ULT flashes 105% yield with a 1.30% fee and negative 72% in 10 months at extreme risk. SCHD it's near 3.5% yield with a 0.06% fee and strong positive 10-year results at low risk. The story is stability versus spectacle. Steady income with capital stewardship versus rocket fuel that scorches the tank. Pro insight: fee drag matters even more when strategy turnover is high. Join the Channel Vest community. Subscribe and comment to shape our next deep dive. That gives context. We translate it into investor behavior and why people still chase the 135% headline. I will simplify what matters here. Psychology sells the sizzle. Big yield triggers behavioral bias. Retirees prioritize immediate cash. Complexity creates aura. And social hype rewards screenshots of monthly deposits. That is a perfect storm where marketing triumphs over math. The result is 7DB piling into products that cap upside and recycle basis, because the near-term dopamine hit is loud and the long-term capital decay is quiet. Pro insight: when a payoff is frequent and visible, humans overweight it versus infrequent compounding outcomes. With that clear, we open the hood on the tax side that turns stealthy later into pain at sale. May make this easy. Return of capital lowers your cost basis, so selling later can create a taxable gain even if your account lost money. Example: rhythm only, not advice. Invest $10,000, receive $4,000 return of capital. Your basis becomes $6,000, sell for $7,000, and you owe tax on $1,000 despite a $3,000 economic loss. That is the hidden trap. When distributions are labeled softly, but the ledger adjusts silently. Pro insight: this can force investors to hold longer than they want, chasing more distributions to offset tax friction. We have the numbers. Let us turn to risk and the few scenarios where this can actually help. Here is the core idea. The strategy can work in specific regimes. Market crash scenario lifts option premiums and buffers downside. With income sideways, markets make regular call selling effective. High VIX volatility index environments feed juicy premiums. The spoiler is frequency. Those conditions might show up 20 to 30% of the time, while the other 70% is trending or grinding up, where upside is capped and decay accumulates. Pro insight: regime detection is notoriously hard in real time, so most investors arrive late to the right weather. That is, performance allocation choices show up in what institutions actually do. Let us zoom into the verdict from big money ratings. Cite below: average parent quality and stewardship concerns. Institutional holdings are minimal beyond market makers, and academic wort flags capped upside with elevated risk is unsuitable for core positions. When the pensions, endowments, and insurers stay away, that is a loud tell. This is not about secret alpha. It is about product design and incentives. You are seeing Wall Street facilitate trading, not allocate capital. This is insane in a different way because the marketing machine is so strong. Pro insight: when smart money will not be the bag holder, retail should ask why. That was the what up next is the explicit risk-reward math. May make this easy. The deck itself lays out ranges. Expected 12-month outcome shows NAV, per share assets decline of 45% to 55%, distribution yield of 95% to 15%, and total return of plus 40% to plus 60% if reinvested, with maximum risk of an 80% loss. Probability estimates list positive total return at 60 to 65%, beating JEPI at 30 to 40%, beating the SP 500 at 15 to 25%, and catastrophic loss at 20 to 25%. Translation, timing, and reinvestment are everything, and tail risk is real. Pro insight: if your plan cannot survive the 20 to 25% catastrophic tail, position sizing must be small or zero. We have the headline. The fine print lives in the community and what we tackle next. I will simplify what matters here. This series exists to expose designs that feel good and perform badly, and to guide you toward strategies that compound. The ask is simple. If this deep dive sharpened your thinking, stay close for more, because the next investigations hit popular real estate, ETFs, and more exotic strategies investors are piling into. We will also open Q&A sessions and keep testing ideas the community votes for. Grow inside your best edge is understanding what you own and why it pays you. Tap subscribe and add a comment so the next strategy finds you fast. We just mapped the macro company mix tells you nothing here, but the deep question we close with does. Make this easy. The question hanging over all of this is why 17B flowed in if the flaws are this obvious, and what that says about financial literacy and the hunger for yield in today's market. The honest answer is that marketing, human bias, and the need for monthly cash can overwhelm sober math, especially when the numbers feel comforting and the pain is delayed. If you take one thing from this, it is to separate distribution optics from total return reality and to use strategies that fit your risk, your timeline, and your temperament. Subscribe for the next deep analysis and leave a comment on what to cover next. Goodbye and take care.